Good evening. My name is John Herron. I am the Director and Chief Executive of the Kansas City Public Library System, and I want to welcome and thank you for joining us this evening. The thank you part is because of this. All of you, a full auditorium, as well as an acclaimed author here to discuss a book on an important public issue. This is how a contemporary library serves its community. Of course, we're still about books, we always will be, but as we hope you also know, we're about much more. And part of that is how the library can serve as a public square, as a place for public disclosure, as a place for the civil and civic exchange of ideas on difficult cultural, social, and political issues. It is with incredible pride that we are happy to be once again welcoming people back into our spaces after a couple-year interruption by the pandemic. Yes. We resumed in-person programming in March, and we have been very gratified to see our audiences return. Tonight, look around, you are part of the largest crowd at one of our signature events series since February of 2020. Can you even remember February of 2020? And of course, there is many, many times more than this that are live streaming this event tonight as well. Of course, much of that interest has to do with Christopher Leonard. As an author, Christopher has made the habit of accomplishing the remarkable. 2.5 years ago, he managed to burrow into the empire of Charles and David Koch for his best-selling book, Kochland. Before that, he was the author of The Meat Racket, The Secret Takeover of America's Food Business, a revealing look at the big business move into meat production in our country. Well, now, with Lords of Easy Money, How the Federal Reserve Broke into the American Economy, he bores into the monolith that is the Federal Reserve, one of the most important, if probably least understood elements of our economy. Lords of Easy Money makes the work of the Reserve comprehensible, even fascinating, and as we'll probably learn tonight, certainly not infallible. Kansas City is rightfully proud of its literary heritage, from Ernest Hemingway and Evan Connell to Calvin Trillin, William Least Heatmoon, and Candace Millard. Well, Christopher Leonard, born here, raised here, and still residing here, is part of that tradition. He has written 3 books. All of those books are consequential. And with his presentation tonight, Christopher will have spoken at the library on all 3 of those books. His writing has also appeared in the New York Times, the Washington Post, and the Wall Street Journal. He is a graduate of the University of Missouri School of Journalism, and 3 years ago, he helped launch that school's Watchdog Writers Group, a groundbreaking nonprofit fellowship program and teaching lab focused on investigative reporting. He serves as the executive director. Again, thank you for joining us tonight. We're going to try to make time for a few questions at the end. If you're in the audience tonight, you can come down to the microphones that we'll place in front. Those of you who are joining us on live stream, please submit questions via the YouTube chat box. Moderating our discussion tonight is David Hudnall. Many of you may already know him. He is a reporter for the Kansas City Star and former editor of The Pitch. He will be serving the role of interrogator of Christopher this evening. So now, please help me welcome Christopher Leonard and David Hudnall back to the library.
Hey. Hi. Thanks everyone for being here. Thanks Chris. Thanks the library. We love the library. I thought we would start. Do I sound okay? Good. No? Louder? How about now?
Well, we got mic'd rather involuntarily, so I don't know. Can people hear me okay? I don't know.
I'll try and talk much louder. Oh, that sounded a little better. Okay, here we go. I thought we'd start with a pretty simple question, straightforward.
Good.
Which is, when is the stock market going to crash? Should I sell my crypto? Please help me.
I am sorry to inform you the stock market is crashing as we speak.
Yeah. Well, I want to talk, we'll get back to that, how about? So just as I wrote a story about you for the Star a few months ago, you and your book, The Lords of Easy Money, which I guess we all know. And it was sort of one of those deals where I told, my editor was like, You want to write about a guy who's writing about the Federal Reserve, like, we're trying to stay in business here. But it actually got a lot of readership and a lot of audience. I got a lot of good feedback on it. And I think the reason is because people are confused about the economy over the last 10 or 15 years. And you have this kind of, the book is this well-researched sort of narrative that sort of explains a lot of that. And so, one, I just sort of wanted to praise you for that. But two, and you should all read the book, of course. But two, I thought maybe we could start talking about the book, and then we could move into talking about the implications of the book, which we're seeing right now in the economy. So, I guess my first real question is, you know, what sort of led you to writing about the Fed? You had written these other sort of business books about the Coke industries and about the chicken monopoly, Tyson, right?
That's right.
Yeah. So you were sort of in the same world, business and government, but why the Fed?
Yeah, thank you. And I mean, imagine how my editor felt when I came to her after I'd done a book about the Koch brothers and said, okay, my next book, I want to write about quantitative easing. It didn't make sense, but that's kind of why I wanted to write this book. And this book, I'm really glad to start here with where this whole thing started. And if I could kind of make a side comment about journalism today, you know, you and I are still kind of struggling to be in this world of print journalism. And I think one of the biggest problems in our business is reporters trying to show that they're smart, you know, and this whole idea that you can sit there at a desk and be smart and share your brilliant ideas. In fact, I think what's important is to have sources who are smart, and that a reporter is only as good as their sources, and that the key to doing this job is to talk to as many people as you possibly can, to listen to them, to synthesize what they tell you, and to be honest about what you report. And that whole ethic is really important to me, and that's where this book came from. So I was reporting on Cokeland, and it really gave me the privilege of being in contact with all kinds of people who I wouldn't ordinarily meet. And one of these guys I interviewed him on background. I'm not trying to be cagey or whatever, but he wanted to be anonymous, which a lot of people do. And he quickly said, fine, let's, you know, Coke Industries is interesting, but can we talk about what really matters right now? I want to talk about asset markets. And this guy talked to me for 5 hours about what he was seeing in the marketplace. He was one of these like super smart hedge fund investor in the market types. And I had been a business reporter at that point for, 15 years. And I had this like vague notion that the Federal Reserve was doing things that were aggressive and ambitious and large scale. But when this guy walked through what he was seeing, it blew my mind. I mean, the headline I took home from that was that between 2008 and 2014, in about 4.5 years, the Fed printed more than 3 times as much money as it printed in the first 100 years of its existence. So that was like 350 years worth of money creation in 4.5 years. And this money wasn't a neutral force. It coursed out through our banking system. It reshaped our financial markets and our economy, and was just massively consequential. And I realized I didn't understand this. And first of all, I thought this guy was crazy. So I went home and started reporting and started researching and realized the picture he had given me was accurate. And so I kind of set off on this course in 2016 after that interview to understand what the Fed had done and how it had reshaped our economy.
And so how did that take you to Tom Hoenig?
Well,
who is sort of a central character in the book.
Absolutely. Tom Hoenig, from Kansas City, was the president of the Kansas City Federal Reserve. And unfortunately, I wanted him to be here tonight, but he is going to Washington, D.C. to meet with a group of lawmakers and couldn't cancel it. And he's not the kind of guy to cancel appointments, you know. He's an appointment keeper. And so as I told you, I kind of got home and I wanted to understand what the Fed had done, so I started reporting and reading on it. And quickly, the thing you see is that history really changed on November 3rd, 2010. That was when the top committee at the Federal Reserve took a very consequential vote to undertake this experimental policy we're going to talk about called quantitative easing. Aggressive, experimental, I can't use that word enough, unprecedented and experimental money creation as basically like a jobs program. This policy began on November 3rd, 2010, and the vote to do this was 11 against 1. And you know, as a reporter, that's like a really interesting vote tally. You know, it's not close, and it just made me think, who was the one guy who voted no? And it turned out to be a guy, and it was Thomas Hoenig. And he was president of the Kansas City Fed. I vaguely knew the name. I think one of his sons was a friend of a friend, but I didn't really know much about this guy. And so I started to report on that vote and the sort of policy debate, and started to kind of research this guy and try to understand why he voted against it. And the story that unfolded really amazed me, actually. I interviewed Tom Hoenig for the first time in 2016, and I remember calling my editor and my agent right after that and saying, like, this needs to be a book. What this guy did is amazing. And, you know, quickly I'll say Tom Hoenig is a guy who got misremembered by history, okay? When I asked around in D.C., where I lived at the time, people said, oh, Hoenig was an inflation hawk, you know? He was this hardcore, hard money guy who was worried about price inflation. He voted no all the time at these Fed meetings, and he was sort of this reflexive dissenter. Ben Bernanke, who's chairman of the Fed, real key character in this history. Bernanke was, I'll say, like, aggressively uncharitable in his characterizations of Tom Hoenig in Bernanke's memoir called A Courage to Act. But when I dug into the actual historical record, the transcripts of the debates that were happening inside the Fed, and then the public comments of the Fed leaders, I realized the story wasn't that simple at all. Tom Hoenig was not a reflexive dissenter. This is not a guy who just reflexively voted no at Fed meetings. In fact, most of his career, he never voted no. But then in the year 2010, he voted no at every single meeting. His vote tally was no, 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 no. And really, that defined his career. That's what defined him as a dissenter. And when you look at the arguments he was making, they were very, very nuanced and fascinating, and really actually had very little to do with inflation.
And we should say, I mean, those arguments, a quirk of the way that the Fed works is that you don't get to read those arguments until 5 years after they have made them. Isn't that right? Yeah,
the Fed is beautifully orchestrated to avoid democratic accountability. And it was built that way intentionally. So if we could maybe take a sidetrack to talk about the central bank, the Fed. We created it in 1913, and it really had the key job, the super important job of creating and managing our currency. The US dollar is actually a Federal Reserve note. That's an incredibly important responsibility. And the Fed was also built to be the kind of safety net bank, the lender of last resort. So when there was a banking panic, the Fed would step in and lend to otherwise healthy banks. And so the Fed had that job. And when we built the Fed through Congress, we decided we need to insulate this thing from voters, because this power to print money is such a great power, and it's so susceptible to abuse, you know? I mean, what government in the world doesn't want to avoid the tension of either raising taxes or cutting spending? That's a hard choice. And one way to escape that tension is to simply print money. And we've seen again and again in history that when you try to rely on the printing presses to run your country, it leads to inflation and ruin. So we said, okay, we're going to insulate this institution from voters so that the leaders of the Fed can think long-term, they can do the unpopular thing, and they can do what needs to be done to manage our currency. Okay, so sorry, you asked me a simple question about the transcripts. And this committee at the Fed that runs it is called the Federal Open Markets Committee. It's a committee of 12 voting members. They meet every 6 weeks. When you hear that the Fed raised interest rates, it was this committee voting to do so. And they hold 2 days of discussions and debates that are transcribed. and held for history. But as you point out, the transcriptions of the debates aren't released until a delay of 5 years has passed. And they're really smart about how they do this. They will release an entire year's transcripts in a day. So imagine being the New York Times or Wall Street Journal reporter getting, 5,000 pages dumped on your desk and finding the news in it and getting it in the paper the next day. So what ends up happening is there are a few snippets here or there, but the texture of these debates gets lost. And so one of the real privileges, I guess, of being an author or a longer form journalist is, you got the time to read through these numbingly tedious at times transcripts and reports. The supplemental reports that they give and the debates that they have. You can go back and read through it and get a much more clear idea of what happened. And that's exactly what happened here. When I went back and read all of the debates from the year 2010, listen, a very clear picture emerges. You had this ambitious Fed chairman, Ben Bernanke, who was absolutely determined to never be accused of not being aggressive. He had learned from the Great Depression when the central bank was too hesitant to act.
He was a student of the Great Depression, right? Isn't that like what he wrote his...
Yeah, he was like, that's kind of even understating it. He was a student and professor and had written, was a brilliant professor at Princeton, PhD economist, had written widely about the Great Depression, and the lesson taken from the Great Depression was don't hold back, right? And so in 2010, the Fed had already responded to a massive financial crisis which the Fed had helped create. We must point out that the Fed helped create the global financial crisis of 2008 by keeping interest rates too low too long and stoking the housing and debt bubble that exploded. Look, I'm a reporter. We love to pick on greedy bankers and the shady mortgage dealers and people like this. But the Fed sets the structure of the incentives. The Fed decides how cheap debt will be. And the Fed helped create that crash and then helped print more money to bail us out of that. And then in 2010, these debates really centered around should the Fed continue to intervene or not.
And so that's around the time, that they did two important things, which is, I guess you could describe quantitative easing now, and then keeping the low interest rates. I'm sorry. I'm so sorry.
You really need to yell, man.
Move my mic up. Oh. How's that?
I can repeat it. Poor David did not set up the mic.
I'll kind of talk a little bit into it.
That's better.
Talk about the two things that the Fed did around 2010 that are really pivot moments.
Yeah, so the things the Fed did in 2010 and the things that Tom Hoenig tried to stop. And this is why I think Tom Hoenig's story is so important, is that we reach this moment, which, you and I, and probably everyone in this room really remembers, 2009, 2010 was an economically grim moment. And we were in the shadow of this financial crisis. And, it's not coincidental that on November 2nd, 2010, the Tea Party movement takes control of the House of Representatives. And this was a political movement that was, the stated goal was to sort of stop Congress from intervening further in our economy. So they're sort of trying to sideline Congress from action. And what was happening inside the Federal Reserve was they were having a debate as to whether or not they should really push forward and take the role that Congress had traditionally served of trying to drive economic growth in America. And to do so, they really had two tools. They could keep the interest rate at zero, as you just said, which in itself is extraordinary. Interest rates historically have floated between about 3% and 6% when you really look at it. And this is like the base rate of the cost of money and the reward for savings. It's a pretty fundamental metric of our economy. And the rate had brushed up against zero very, very briefly, I think one time in the late 1960s. And when the crisis hit in '08, the Fed put rates to zero at like emergency footing, but then it kept them there. So by 2010, rates are still at zero, and there's this debate in the Fed where people like Tom Hoenig are saying, we have got to lift up off the zero bound. And Hoenig wasn't advocating, hiking interest rates to even 2%. He said we need to sort of moderately increase this rate so that we'll have room to maneuver in the future and that we can avoid really caustic negative side effects of having a zero rate, which we can talk about. But Bernanke was saying, no, we need to do whatever we can, and at the same time, we're not just going to keep rates at zero. We're going to do this thing called quantitative easing, which is creating new money inside the banking system. And quickly, it's worth talking about the mechanics of how this works.
One of my favorite parts of the book really is learning about how the banks are involved in the process of getting that money to the banks.
Why did you like that part?
It's just like, it's such an obvious question that I did not know the answer to. Like, how do they actually put money into the economy?
See,
yeah.
Same. Like, as a business reporter, you hear the Fed set interest rates at 1.5% today, but that really obscures what's going on. That committee we mentioned sets a target rate for interest rates. And then the Fed has to actually go out into the world and make it so. And they do that by printing money in the banking system. It's amazing. There's the New York Federal Reserve has this trading floor, unlike any in America. Picture like a bank trading desk. I've actually toured the Fed's trading floor in New York. And it's extraordinary in the sense that this is how the Fed affects interest rates, okay? They have these traders, these young financial traders sitting at these desks. And what the trader will do is call up a bank like JP Morgan and say, hey, I would like to buy a treasury bond from you, JP Morgan. And JP Morgan says, sure. And they sell that treasury bond to the Fed. And then the Fed says, look in your bank account. $8 billion just appeared to fund that purchase. The Fed just created the money for the purchase out of nowhere. And over the decades, the Fed had used this power to create new money in the banking system to essentially lower or raise the amount of money on Wall Street. We call it base money, newly created dollars. And the Fed did this sort of delicate balance over many years of lowering and raising the amount of new dollars in the system, which affects the interest rate. So, when you want to tighten, you take money out of the banking system. When you want to loosen, you push money in. And what Bernanke was proposing in 2010 was to use this power in a way it had never been used in America, which was to buy long-term treasury bills and not just tinker around the edges, but to flood money into Wall Street. Here's a good metric. When the Fed creates money in the banks, it does it by purchasing things. So you can measure the Fed's footprint by how much it's purchased. I'm sorry if that's a little complicated, but the Fed had $900 billion in its account in 2008 when the crisis hit. That's $900 billion created over a century, $900 billion. And then in a year, it creates another trillion, like doubles the money supply. And then between 2008 and 14, Bernanke executes this plan of quantitative easing where they print another $2 trillion, essentially, $2.5 trillion. So we have $3.5 trillion over those years pumped into the banking system. And it changes the world. So Tom Hoenig was saying at the time, inside the Fed, don't do this. You're going to get very limited benefits, okay? All you're going to do is encourage banks to, they're going to get all this cash, interest rates are going to be zero, the banks are going to have zero incentive to save the money, and they're just going to go out there and make riskier and riskier bets. You're going to be pushing them out on the risk curve, as they say. And at the same time, Hoenig was arguing that the Fed would only really be enriching the very richest Americans who own the vast majority of assets in our country, because this policy, by pumping cash into the banking system, was going to elevate asset prices. And the top 1% of the wealthiest Americans own 40% of the assets. The top 10% own 65% of the assets. And Hoenig, who is sort of characterized, looking back, people characterize him as this almost like Neanderthal, right-wing, hard money guy. He was actually making an argument that you're going to be widening income inequality. You're going to be hurting wage earners. You're going to be hurting pensioners. You're going to create another massive asset bubble, just like the one that just exploded. And he wasn't the only one making these arguments in 2010. He was joined by other senior officials at the Fed, but he was the only person who voted against it.
And so, when do we start to see the effects of those policies, in the economy? What would be some examples of, in the last 10 years, where we see
Yeah. So that's why does this all matter? The whole middle part of the book is I'm trying to kind of portray what happened in the 2010s during this easy money era when, amazingly, Tom Hoenig was saying, don't keep interest rates at zero, and he was overruled, and the Fed ended up keeping interest rates pegged at zero for 7 years. That's nearly a decade that you have 0% interest rates. At the same time, the Fed is pumping the money into Wall Street. And the effects begin to appear almost immediately, and the effects were exactly what Thomas Hoenig warned about. And I'll put it this way. It did three key things. It encouraged a huge upswell in the assumption of debt. Corporate debt almost doubled. Corporate bonds, leveraged loans, they almost doubled. They hit a little north of $10 trillion. U.S. government debt swells and, is kept very, very cheap and increases. And, household debt didn't increase as much as some of those other ones, but also increased. Because the key thing, this was going to create much, much cheaper debt. It also had the effect of elevating asset prices, okay? And to talk about that, it's just like picture all this cash going into Wall Street, and it's got to find a home. This money has to find a home. And all the money started chasing assets like stocks, commercial-backed real estate bonds, those corporate bonds and leveraged loans, which were packaged and syndicated just like the home loans had been in the 2000s. All of the value of these assets starts to rise, and we started to create these asset bubbles that Hoenig had warned us against. And that created fragility in the financial system. So ultimately, what you see over the course of the 2010s is that these policies enrich the richest Americans. They swell the debt levels and the fees of the biggest banks on Wall Street. And they benefit wage earners very little, if at all. Really, very little, if at all. The unemployment effects of this were small, and the Fed knew they were going to be small. Wages were essentially flat for a decade during the 2010s, while at the same time, the value of these assets, like the stock market, doubles. So that's why we see this very strange kind of funhouse economy or funhouse mirror economy where asset markets are just booming. And the wealth of the richest Americans is growing really rapidly, while the huge portion of Americans in the middle are treading water at best. That's what we see between 2010 and 2020.
I want to talk a little bit about what's going on right now. So what do you think about, so maybe how does the book explain what we're starting to see in the markets right now?
I think okay, so to talk about what we're seeing right now is unpleasant volatility in the markets, right? That's interesting in how it's playing out. The stock market over the last few days is down, what, like 6%, I think, since last 10% in like a week. And as of last week, the Standard & Poor's 500 stock index was having its worst start to the year since 1939. Not great. But then what's interesting is alongside that carnage in the stock market, you're seeing the much larger bond market is the prices of bonds. And God, nothing makes people's eyes glaze over more than the word bond market. But this is like the enormous, I just can't emphasize enough, hypercritical market for United States government debt, municipal debt, and corporate debt. It's becoming less and less valuable every day because people are trying to sell it. They don't want it anymore. So you're seeing the value of this debt drop, and then critically, what happens when debt prices fall is that interest rates rise. And I like to think of interest rates as an index of desperation, basically. If you're really desperate, you need to pay a high interest rate to borrow money. If you're in great shape, you need to pay low interest rate to raise money. Probably the most important interest rate in the world is the interest rate on a 10-year Treasury bond from the United States government. That we should be just kind of talking about nothing else. 10-year Treasury bond interest rates are very important because in a government that runs structural deficits and borrow money all the time, what we have to pay for that debt matters a great deal. And what we've seen in the last week is that the interest rates on this 10-year Treasury bill have spiked. They've spiked faster than they've spiked since the 1980s. The 10-year Treasury yield, meaning the interest rate or the index of desperation, was about 1.5% at Christmas, and now it's north of 3%. And I'm telling you, having reported this book, when I see interest rates on the 10-year Treasury rising so rapidly outside of the control of the Federal Reserve, it makes me kind of queasy. It's not good. And so, what we're seeing right now is this sort of synchronized downturn in prices and an increase in yields. And it is exactly the effect of what we knew would happen when the Federal Reserve had to do what it's doing now, which is pull back on these easy money policies. Part of the most interesting part of this book to me was writing about the Federal Reserve's efforts to stop these easy money policies. They were talking about trying to stop it since they started in 2010. It's in the debates. And they really tried in 2018. The current Fed chairman, Jay Powell, tried to raise interest rates, to pull back some of this cash. The market started to tank in 2018, bond prices down, stock prices down together.
The taper tantrum, is that what you're referring to?
The taper tantrum, the multiple taper tantrums. The first one was in 2013. And what I'm saying here is every time they try to pull back, the markets react negatively. And the Fed has lost its nerve every single time. 2018 being the most pronounced example. This kind of downturn happened. It was very scary. The stock market dropped 800 points. The Dow Jones dropped 800 points on Christmas Eve, 2018. And the Fed backed off the normalization. So what's happening today is that the Fed is trying to escape the quagmire it put itself into by tightening or normalizing conditions, by raising interest rates, by pulling back some of this extraordinary cash injection it's done, and the markets are reacting. That's what's happening today.
I did also want to talk a little bit about the pandemic response, because that was also a pretty enlightening part of the book for me. I guess I was just sort of distracted at the time, but I wasn't necessarily paying attention to monetary policy, but that was a pretty extraordinary injection of money into the system, bigger than 2008.
Yes.
What do you think about the implications of that? I mean, is that just adding to the pile? Is there anything different to say about it?
So, okay, has anybody seen the movie The Matrix, where if you take a red pill, you can all of a sudden see the synthetic reality around you? There's this group of people who talks about being Fed-pilled, that when you kind of get immersed in this stuff, you see the world a little bit differently. And when the crash of 2020 hit, I feel like Fed watchers saw it in a different way than most other people saw it. It makes a lot of sense that we would have had an economic downturn when COVID hit. I mean, it was an extraordinary economic crisis unlike any we've ever really experienced in modern times. We had to shut down the economy very quickly and then struggle to restart it. Very intricate, global, interconnected supply chain. However, there was this other thing going on beneath the very chaotic surface, which is that when COVID hit, it was the so-called black swan event. It was this synchronized shutdown in economic activity that triggered a stock and bond market crisis worse than 2008. And here's one element of a way I would describe it. All the restaurants had to shut down. And that was a catastrophe, to have restaurants shut down, and airlines shut down, and cruise lines shut down. But all of those companies were made extraordinarily more vulnerable because over the previous decade, the Federal Reserve had incentivized them to borrow more money through corporate bonds. And I mean, I walk through this very step by step in the book by profiling a company called Rexnord, whereby the financial leaders of these companies were like losing money if they didn't borrow cheaply and use it to buy back their own stock or borrow it to issue corporate debt or leveraged loans, so that by the time COVID hits, these firms are deeply leveraged. I mean, the airlines, the cruise ships, they're deeply leveraged with this debt, and so they need to make debt payments. The shops are closed and the debt payments are due. And so we started to see a cascading chain reaction that started to unfold really, really quickly in 2020. The market for Treasury bills literally froze. That you could not buy or sell certain kinds of U.S. Treasury bills. The Financial Times put it well when they said, analysts said such a thing wasn't supposed to be possible, but it was happening. And the bill was coming due for a decade of easy money. The virus, the coronavirus, collided with a very fragile economic system. And one of the things that really gets me steamed is that the people who know most about the markets knew exactly how fragile this system was, that stocks were priced to perfection, that the companies were way levered up, that the balloon was waiting for a needle. I mean, really, they knew this. And the needle came, and it was the coronavirus. And the Federal Reserve reacted by printing 300 years worth of money in a few months in the spring of 2020. They printed $3 trillion basically between May and June. And here's the most important metric to me. The stock market crashed and then was made entirely whole again within about 4 months, I think, and then rose to record levels. And the same is true for these structures of very fragile, very risky corporate debt and leveraged loans. Those began to collapse. And it's not just, the Fed's bailout was like a well-oiled, high-speed train of cash that went directly to the hedge funds, private equity firms, and big banks on Wall Street. The bailout for those folks was done in a day, while, mid-sized businesses and employees of restaurants were waiting for their PPP check to arrive. So the equities markets and the richest of the rich were bailed out quite quickly, but then importantly, the circus continued. Once they saw that the Fed was there to bail them out, no matter what, risky corporate debt has hit even record levels since then. The stock market went on a tear, and this bull market began to emerge after 2020. And let me use this metric again. The Fed's balance sheet, which reflects its footprint, was $900 billion large in 2008. It reached $4.5 trillion by 2014, which at the time, in 2014, people were debating like, oh my God, a Fed balance sheet of $4.5 trillion? This is way out of bounds of historical normalcy. We got to bring it down. They really couldn't bring it down. Today it's $9 trillion. It's $9 trillion. And you've got people out there hypothesizing, well, why not make it 18 trillion? Like, there's no end in sight to this. And so you have a financial system that has become dependent on this flow of money from the Fed. To circle back to what Tom Hoenig voted against in 2010, that has become standard operating procedure. And the financial system is entirely dependent on it, which again brings us to today, if I can. Sorry if I'm long-winded, man.
Got water right here.
I know. This is what happens when you sit in a room thinking about quantitative easing all day. But the worst, most risky thing that could have possibly happened in 2021 and 2022 was that price inflation finally emerged after a decade, okay? When all this stuff was happening, when the Fed was printing all this money and keeping interest rates at zero, many critics said you're going to create inflation and hyperinflation, and it never happened. And in fact, the one entity that has no clue why it didn't happen is the Fed. When you go back and look at the internal Fed forecast year over year, they always thought inflation was going to rise, and it never did. And then all of a sudden, it rushed into the room with a vengeance in 2021, where inflation for things we buy, television sets, cars, food, energy, it's rising at roughly 8% year over year, the fastest level since the 1980s. Now, I need to make a side point here. You've got price inflation for the stuff we buy, and then you've got asset price inflation for the stuff we own. And as I've talked about here, asset inflation has been rising at double digits since 2010. Home prices, stock prices, you name it. But now we finally see price inflation. And this created a terrible dilemma for the Fed, because it is pushing them against that cliff where they don't want to go. They are being forced to do what they've avoided doing for a decade, which is to normalize, which is to hike interest rates higher to fight this inflation and to withdraw some of those trillions of dollars they put into the banking system. And it's been fascinating to watch this year. We're watching a tug of war. You've got a financial industry that's saying, come on, Fed, we know you're going to bail us out. We buy the dip, if you've heard that expression. When stock markets dip, you buy it, because you know the Fed's going to step in and bail you out. And this sobering realization is starting to sink in that the Fed might not be able to buy the dip right now, because they're going to have to fight inflation. The Fed is either going to have to tighten and normalize or accept rising inflation. And so, the past few days, the market has had this step-down drop. And to me, everybody in this field uses the drug analogy, the alcohol analogy of a financial system dependent on easy money. And to me, what you're kind of seeing over the last few days is a bit of the waking up that the Fed might not be able to step in, and we might be entering a new reality.
Let's open it up. Audience questions.
If you have a question, if you would please use the microphones up here so that the folks watching at home can hear the question as well as the answer. And if you'll give me just a minute, I'm going to start with one person that's watching online. They would like to know, why wasn't more of this money required to use to stave off foreclosures? And along those lines, I wonder if you could share with us the story of Mnuchin, Dell, and Soros.
Okay, so this is talking about the bailouts of 2009 and 2010, and the question is, why wasn't this money used to bail out homeowners who were in foreclosure, which was actually, the eviction and foreclosure crisis of 2009, 2010 was one of the most destabilizing economic crises of the modern era. It put a lot of families out of their houses and was deeply destructive to wealth of middle-class America. Here's why this money didn't directly go to bail them out, because the Fed does not have the authority to take actions like that. As we kind of talked about, I didn't really articulate it well, I don't think. The Fed can create a lot of new money, but it can only create it in one way through one channel. It can purchase assets from a group of 24 banks on Wall Street called primary dealers. That's how it does quantitative easing, that thing I just described. The Fed can't put money in the bank account of Chris Leonard or David Hudnall. the Fed cannot build a school. The Fed cannot put a shovel in anybody's hand. The Fed cannot build a dam. The Fed can pump money into the bank accounts of the primary dealers, and that's all it can do. So in 2010, when the Fed decided that it was going to take these actions and move into this job of basically creating a jobs program, it could only do that through the vehicle of the banks. And the means were limited, the tools were limited, and the Fed used the tools it had of creating new money to the maximum degree it could. To do things like bail out homeowners or, restructure the banks, which is something I'd like to talk about in a second. Only democratically controlled institutions like Congress can do things like that, and Congress did not do things like that in 2010. And incidentally, regarding our subject, Tom Hoenig, he ended up retiring from the Federal Reserve and then going back to Washington, D.C. to be vice chairman of the FDIC, the biggest bank regulator in the U.S. And he showed up in town with a plan to break up the big banks. This, it's just sort of remarkable how this guy always seems to have the right idea at the right time and to be entirely ignored by the establishment in Washington, D.C. And his argument was that we need to break up these banks because they're using the FDIC's safety net and bailout mechanisms to run a casino. And that's not fair to taxpayers, which is a rather common sense opinion, but it runs up against the power of the biggest of the big banks. So Hoenig, his plan, which they called the Hoenig plan to break up the big banks, became a dead letter in Washington, D.C. And so, the question of why didn't they bail out homeowners, I think, drives to that bigger point of the Fed's limited tools, and it can really only create money.
So it seems to me, my name is Harold Bradley, and I've been in the investment management business here in Kansas City for a long time. I was the chief investment officer at the Kauffman Foundation when Tom was on the board there. So I had a sideline view of the time you're writing about. What seems to me to be missing a little bit from what you've discussed, and maybe you could amplify, is that when we talk about bailing out the homeowner, the banks were in deep trouble because the asset values of what was behind the loans they'd made were collapsing. So the idea of putting the money into the market was to get the asset values of the collateral up so that we didn't collapse. And they turned basically private equity and hedge funds around the country into a bailout group, different than the bank bailout from the S&L crisis. Fast forward to all the money you've just said is created. Now we have a different problem that I'd love you to comment on, because every central bank in the world now tries to operate like the Fed. We have a global supply chain that's broken. We have easy money policies in China fighting the U.S.'s higher money policies. And we have interest rates rising with commodities going up. That doesn't normally happen. So I'd like to kind of get your sense of whether we're not talking about the Fed as an iconoclastic by itself institution in a world right now that's at war with supply chains from China to here, with Russia and the Ukraine, and what that does to complicate the lives of people who think liquidity is the issue.
Wow. Yeah, I mean, that is a very smart.
I'll let you take that one.
Yeah, exactly. I mean, and like, forgive me, there's so much to unpack there, because, these are really important points you're bringing up. So if I could, if I could just kind of make one point at the beginning. When we talk about Tom Hoenig's series of no votes in 2010, the banks, okay, we had homeowners who couldn't pay off the debts they had assumed, and that brought down the...
by congressional policy to make it easier for qualify to own homes.
Well, I feel like we're really going to descend into a conversation. I actually don't think that the federal mortgage requirements played as big a role in the home loan crisis as did the interest rate issues and the behavior of the private sector banks like Countrywide. And so I feel like this is something that we could really kind of parse through. But, you know, let's leave it there for a second. Here's the point I'd like to make in 2010. In 2010, we were on the other side of the crisis. Okay, the Fed had already printed $1 trillion roughly, and it had rushed liquidity into the markets, and it saved the banks from failure. It propped up asset prices, and it did quantitative easing for the first time in that emergency moment to prop up the mortgage system. And I think what Tom Hoenig's dispute was in 2010 was, now we're in a different phase. We had the crisis of 08, we had the crisis of 09, but now we're in 2010, and yeah, things are bad, and we knew they were going to be bad because we've got this hangover from the bad debt. And what the Fed was choosing to do at that time was, I just keep calling it like a jobs program, that they were going to try to bring down the overall unemployment rate and drive the American economy forward through this money printing. And it wasn't just about saving the banks. It wasn't just about, we're going to drive up those asset prices to make sure the banks are solvent. It was like, we're going to try to push the entire economy forward and bring down that unemployment rate. I think that's a different thing than just trying to bail out the banks in the moment of crisis. And if I could, your bigger question about where we are today, I mean, okay, you're bringing up the question about the fact that you've got this interconnected system of global central banks. Very, very interesting because, you know, the Fed plays a role in the world that is obviously unique because of the unique reason that I didn't have time to really go into in the book, but the dollar is the global reserve currency. When other banks around the world want to save money, they save it in dollars. That makes us extraordinarily special and unique and powerful and influential in the world. When the Fed acts, it affects the world. And when the Fed does things, it motivates others to follow suit. And you're right that some of the things the Fed is doing now can be counteracted by the Central Bank of China. We're trying to tighten. They're trying to loosen. That's a very real effect. I do argue that the Fed is the most influential bank in the world, and it affects what the other banks do. And really my concern in the book, my core concern is about the domestic economy. And, you know, I haven't really highlighted the point, but to me the core concern is about income inequality. My previous book was about Koch Industries and corporate power in America. It was kind of a history of U.S. corporations since 1967. And the key question to me is, why is income inequality widening? And why do we have an economy that can grow for 10 years, but the gains are captured by an increasingly small group? To me, that's one of the primary dilemmas we need to examine as journalists when we look at the economy, and I think the Fed played a key role in that. So to me, my core concern is what this has done domestically to the United States. And I am going to use that to dodge your last question about rising commodity prices in sync with rising interest rates.
And the value of the dollar.
And the value of the dollar. Can I cry mercy on that one? Because I have not kept up with commodity prices over the last month. And it's been very interesting because the supply chain issues are driving up oil and food and wheat. But also the commodity prices were inflated by the easy money policies I'm talking about. And so the downturn does tend to be among commodities, bonds, debt, and stocks, but we're seeing this variable of commodity prices rising right now. But I'm going to stick with my basic story, which is that the Fed is trying to tighten and normalize now, and they're not going to be able to do it without pushing us through a very difficult period.
I think we'll go over here, and then I have one more online question that we'll finish up with.
Mine, I think, relates to income equality, and it may not have much to do with your book. It's a concern of mine where, with the 2008 crash, there were areas of our country that were already depressed And the 2008 crash depressed them further, meaning there just weren't jobs available. Those jobs have never come back. And I feel that that's part of creating the division in our country. So it relates to income inequality. Because those people, I think, have just lost hope.
Yeah.
Because the jobs aren't there, and they're not coming back. Nobody's investing in those areas. So is there anything related to the Fed in that whole scenario?
Absolutely, and I really hope, I think your question came through very well on the microphone, and it was about growing income inequality and regional income inequality and how some parts of the country have been battered much more severely than others. And I mean, that is a core part of this book. The middle part of the book tries to portray how these easy money policies have interacted with exactly the economy you're talking about. I profile this old school industrial conglomerate in Milwaukee called Rexnord. And Rexnord, as a case study, shows exactly the negative effects of these easy money policies. And it's fascinating. I strongly recommend you buy the book to read this story. The current chairman of the Federal Reserve, Jay Powell, began his career in the world of private equity, where you use corporate debt and leveraged loans to buy out companies, load them down with debt, cut costs, lay off workers, and then sell the company to the next private equity owner. Jay Powell made tens of millions of dollars buying and selling this company, Rexnord, loading it down with debt. And then I kind of portray what happens next. And the key point is that these easy money policies just encouraged financialization and the destruction of real-world jobs. And I portray a guy named John Feltner who works at Rexnord. He's exactly the kind of gung-ho, hard-working person that you'd want to have in your economy. And his life has economically been a step ladder down with each job he's gotten and been laid off from, and a story that continued at Rexnord. And at the same time, the people who own and sell Rexnord junk debt were earning record fees and making a lot of money. So I would say, actually, you know, the issue you brought up is a very core issue of mine. And I'll tell you one final thing. You know, I've gotten in a lot of trouble because this book appealed to conservative audiences right off the bat, because I think they have an instinctive skepticism about the Fed. But at the end of the book, I talk about some of the social instability and disruption we see right now, which I characterize as sort of culminating in an issue where you've got a lot of angry people storming the Capitol to try to stop an election, and then the next day the stock market hits a record high. That shows a disjointed system to me, whereby, you know, asset prices aren't really tethered to the underlying health of the society or the economy anymore. And I think Tom Hoenig argues, and I agree, that these things are intertwined. That when people lose hope, gosh, he was making these arguments when he went back and advocated for the banks to be broken up. When he was at the FDIC, Hoenig was saying, when you bail out the banks, people are going to lose faith in the system. They're going to see these other people get bailed out while they're getting nothing, and it's going to create cynicism. And that's, in fact, one of the most important elements of this whole picture. And I think he's right. So the growing social instability is a big part of the story in my mind, and I'm glad you brought it up.
We'll try to sneak one more in here, and then we'll finish with my question watching at home.
I really enjoyed your book, and I enjoyed the Cokeland as well. I think they're marvelous, and they get at very, very important issues. But I would like to argue that the Federal Reserve has the wrong policy tools, that the financial markets on Wall Street have become more and more separated from the real economy on Main Street. And when I was a little boy, and I'm 77 years old, you could go to any post office and cash a check or set up a savings account at the post office. But right now, here in Kansas City, if you want to buy a certificate of deposit, a one-year certificate of deposit, you can only get like 0.3% or 0.5% for a 1-year certificate deposit. If you have $50,000 or more to invest, then you can get 1%. But in the financial markets, they know that the U.S. Treasury is offering I-bonds that as of May 1st pay 9.62% on a U.S. Treasury I-bond. And you say, wow, I'm going to go and get these I-bonds. Well, sure, if you're Jay Powell and you have $55 million, well, you might not even bother because they're maxed out at $10,000. You can invest anywhere between $25 and $10,000 in an I-bond. But the problem with the I-bonds, unlike the savings accounts at the post office, with the I-bonds, you cannot withdraw any of the money for 1 year, and if you withdraw the money within the first 5 years, you're heavily penalized. So for the middle class and the lower class, the ones with the highest marginal propensity to consume, the ones that you get more bang for the buck in terms of impacting their behavior, in terms of their demand for goods and services, it doesn't have any effect because they're not going to get into these I-bonds because they can't afford to tie up their money that long. What if they have an automobile accident? What if they have a medical emergency? They can't tie up their money that long. Whether they want to put in $25, $100, $1,000, they can't afford to do that. Yeah. And yet they're the ones that you can have the biggest impact on when you increase the. So instead of increasing the rate, the interest rate on borrowing, which impacts suppliers, some supplier wants to add another line of production because he's being maxed out on supply, right? Because inflation is too much money chasing too few goods. Yes. So he's trying to add another production line, but all of a sudden the cost of borrowing has gone up and he can't afford. So I gave a talk earlier at the American Economic Association meetings on how to stop inflation without causing a recession. So the basic idea is to create, and just to get to the bottom line, is to create Federal Reserve accounts for everyone. Now, everyone with a Social Security number has a Social Security account. So there's no reason in the world why everybody with a Social Security number could have a Federal Reserve account, a savings account that would pay 9.62%, no penalty for early withdrawal. You could withdraw any time. You could put in $25 or up to $10,000. They make the $10,000 limit because they're not trying to make the wealthy people wealthier. They don't want people putting $250,000 or $5,000.
Can we, sir, can we jump ahead to the question, please?
Okay.
Actually,
what do you think about how to handle this problem of so much money going to Wall Street that the people on Main Street can no longer afford to buy back the value of the goods and services they're producing, and it's producing a tremendous amount of people going into debt, and the government going into debt?
Yes. Okay. Honestly, this is a really, really important point that you're making, which is the structure of the financial system and the tools that the Fed has to affect it. I'm not familiar with I-bonds, but this bigger picture you're talking about of the Federal Reserve having accounts for ordinary Americans is a fundamental, really important thing that I think is actually a great note for people to take away from tonight, okay? Which is that let's just look at the structure of the system. We need to remember the Fed can only create money inside 24 bank accounts on Wall Street. JP Morgan, Citigroup, Wells Fargo, the primary dealers. The Fed cannot create money in post office accounts of normal American citizens. So when the Fed is taking these measures to boost economic growth, it's doing it through the banking system. It's highly inefficient. It's widening income inequality. And the issue you're bringing up is something I have heard talked about, which is, structural reform to the Fed, or this idea that you could print the money in normal people's checking account, which could have arguably a much stronger effect on economic growth. At the end of the day, I think we just all... The reason I wrote the book is hopefully to kind of illuminate how this system works and to talk about the mechanics of it so that we can have a much better understanding of what the Fed means when it says we are going to do quantitative easing. We're going to create another $600 billion, or we're going to tighten. I want us to have a very sharp understanding of who's benefiting and who's losing, the risks that are being built up, and how this system works. And then we can start having much kind of higher level debates of what you're talking about how to restructure this system, because I think we can all see it's apparent that we've got problems with how the system is working today for the vast majority of Americans in the middle.
All right, we have one more question from somebody watching at home, but first I want to let everybody know, if you got a book tonight, Chris will be signing out in the lobby. If you did not, or if you prefer to buy the book later from your favorite independent bookseller, I hope, we have some book plates. I'm sure Chris would sign those as well. Last question, somebody watching at home wants to know, is the reserve still backed by gold, and is the petrodollar among the reasons for other countries banking in dollars? Okay.
Yes, the gold standard is still in effect. No, I'm joking. The United States, this is interesting. The U.S. dollar is no longer tied to the value of gold, and it hasn't been since 1971. And that is really, really interesting to me because, the gold standard, okay, the whole key to managing a currency is having discipline. You've got to discipline the creation of money for reasons we discussed earlier. The gold standard provided a hard discipline. It was tied to the amount of gold in the world. It was an unwieldy system. If the gold standard worked, I think we would still be on it. Now, a lot of people in certain circles get really upset when I say that. The gold standard gets people very fired up. But we decided to move away from the gold standard and essentially replace the discipline of a hard metal with the discipline of this committee, the FOMC. And we were going to create a committee that could sort of exercise wisdom and imposed it. I did not mean that to get a laugh. That was how we created the Fed. And it's so interesting that you see, cryptocurrency out there, which a lot, people are very fired up about that as well. And I think the idea behind Bitcoin is that it imposes discipline through algorithm, that there will only be so many coins, and there will be this hard discipline to it. And to me, to get back to Tom Hoenig again, a lot of what he was arguing was for this political theory that doesn't make a good bumper sticker, which is restraint and humility in the face of the unknown. And that's what he was arguing about, that's what he was arguing for again and again at the Federal Reserve, was let's keep within a narrow band. These wild experimental ideas are going to create danger down the road. And I think he was proven correct on that. And so we are no longer on the gold standard, and we rely on the wisdom of the FOMC to control our currency. And then the final question is the petrodollar the reason why the dollar is the global reserve currency? And I think no, it's not, but it's just a reflection of the dollar's critical role. And my final closing point is we, after World War II, inherited a tremendous privilege in being the global reserve currency. And it's not something that should be taken lightly, and the currency needs to be managed with great care.
David, Christopher, thank you so much for a wonderful evening.
Thank you.